Pat Dorsey, The Little Book That Builds Wealth, The Knockout Formula for Finding Great Investments. Discover the secret to successful investing with this summary of The Little Book That Builds Wealth by Pat Dorsey. Learn how to identify companies that provide the potential for long-term growth and uncover economic moats, which protect your investments from competitors. This book offers valuable insights into recognizing the structural competitive advantages in businesses, such as brands, patents, networks, and regulatory licenses, that allow your investments to withstand market challenges and compound wealth over time.
Warren Buffett's winning strategy. Investors seeking success should buy high-quality companies at good prices and hold them long-term. Warren Buffett's game plan for achieving this involves 4 key steps, which include finding profitable companies, waiting for their prices to fall below intrinsic value, holding on patiently unless certain factors come into play, and repeating this strategy across all investments. Follow this proven approach to invest wisely and achieve long-term financial success. Focus on profitable businesses. Invest in businesses that offer the best returns on capital. While many companies struggle to maintain high rates of return in the face of competition, some, like Johnson & Johnson, Oracle, and Anheuser-Busch, continue earning profits. The significance of economic moats for investing. Economic moats are competitive advantages that protect profitable companies, making them more valuable and viable. They are crucial for investors as they provide protection against strong competitors. Companies without moats have no defense against rivals and may go out of business in no time. Economic moats make companies more resilient, helping them withstand market setbacks. Investors must learn to identify undervalued companies with strong moats quickly. In his book, Warren Buffett discusses the concept of economic moats, which are factors that protect a successful company's business from competitor threats. These moats, like those protecting medieval castles, guard profitable companies from aggressive competition. Without such protection, even the most successful companies can be swiftly overtaken by more competitive products or services. Economic moats are invaluable assets for both companies and investors alike. They make companies more viable and valuable, while also safeguarding investors' funds. Companies that lack moats have no defense against strong competitors and are more vulnerable to market setbacks. The primary task for investors is to identify undervalued companies with strong moats quickly. Economic moats make companies more resistant to any market changes and weather setbacks much better than their counterparts without moats. For example, Coca-Cola, despite making the costly mistake of launching New Coke, remained whole due to its core brand, which represents its primary competitive moat. By learning to spot good, undervalued companies with strong moats, investors can invest wisely in well-protected companies with a higher chance of success. Therefore, recognizing economic moats is essential for anyone looking to navigate the stock market successfully. Competitive advantages. A company's competitive advantages are more valuable than a smart business strategy or large market share in the long term. A moat is a structural characteristic that provides a durable competitive advantage, unlike fleeting factors such as strong management or a temporary market advantage. A company's competitive advantages should be durable and not at risk of disappearing in a few months. Look for stocks with one or more of these 4 structural competitive advantages: intangible assets, cost advantages, customer network effects, and efficient scale. Companies with an economic moat, such as owning important patents, are likely to have a strong competitive advantage that others can't match. Intangible assets. Companies can generate economic moats through intangible assets such as patents, regulatory licenses, and brands. Although valuable, these assets don't guarantee permanent marketplace advantages. Patents provide short-term competitive advantage, while a strong brand allows a company to charge a premium price, like Tiffany & Company. Companies that can charge what they want for their licensed products, such as pharmaceutical manufacturers, have a regulatory moat, which is based on numerous small rules. This concept is better than counting on one giant rule that can change quickly. Nevertheless, customers may abandon a brand, governments can revoke licenses, and other manufacturers may challenge patent holders, so companies should exercise caution. Switching costs and consumer behavior. Customers are more likely to switch to a competitor's product or service if the switching cost is low. The banking industry has high switching costs due to paperwork, and customers tend to stick with the same bank for several years. Companies with high switching costs can charge more for their products and services. Competitive advantage and economic moats. Companies with vast networks, such as Amex, Microsoft, Visa, and eBay, possess a competitive edge and create economic moats. The book discusses the network effect and how companies that can connect users or share data can charge higher prices. Microsoft has a monopoly in the software market, making it almost impossible for competitors to break through. Similarly, eBay dominates the online auction space, making it difficult for new players to enter the market. Companies with large networks have a significant competitive advantage that allows them to charge higher prices and creates a barrier to entry for new competitors. Sustainable competitive advantage. Companies that rely solely on cost-cutting strategies to gain a competitive edge may not sustain it in the long term. Instead, focus on finding firms that have unique assets, better locations, greater scale, and available cheaper substitutes. Economic moats depend less on managerial brilliance and more on the initial cards the company holds. A company's size can also create an unbridgeable economic moat, making it easier to be a big fish in a small pond. Look for a company's size advantage in its manufacturing scale and distribution network breadth. Staying ahead of technological change. Companies with strong economic moats or competitive advantages may remain successful in the long term, but technological advancements can quickly disrupt entire industries. For example, Polaroid's instant developing film was once revolutionary, but digital imaging rendered it obsolete. Similarly, the rise of Home Depot and Lowe's caused the demise of small hardware stores and pressure on suppliers. The impact of technological change may not be immediately evident, but it is crucial for savvy investors to stay aware of changing market dynamics to stay ahead. Strategic investing. Invest in industries with strong competitive advantages or moats, such as software, telecommunications, and media companies. These industries can more readily develop moats and maintain them over time. Companies with highly singular content, like Time Warner and Disney, benefit from strong moats that can amortize initial expenses easily due to low redistribution costs. In contrast, companies that deal directly with consumers, such as retailers and restaurants, struggle to develop significant competitive advantages due to low switching costs. When considering future investments, strategically target industries with greater potential for moat construction and maintenance. Investing in moats. Finding companies with a strong moat is a good investment strategy, but investors should also evaluate the return on invested capital, ROIC, and the company's profitability. While management matters, it is less important than the economic moat. Investors should avoid being swayed by market emotions and should focus on corporate performance. When assessing investment opportunities, consider the company's growth potential, future cash flow, and ability to maintain profitability over the long term. Comparing your valuation estimate with the stock market can help you make better investment choices. Even if you cannot predict the future precisely, choosing to invest in companies with relatively low market valuations and strong moats can increase the likelihood of financial success.
In conclusion, The Little Book That Builds Wealth provides a simple yet effective formula for investment success. Buy great companies at reasonable prices and let them build wealth through compounding over the long term. It emphasizes focusing on companies with strong economic moats, which possess enduring structural advantages like brands, patents, networks, and regulatory licenses. By identifying profitable businesses with the ability to withstand competitive pressures, investors can significantly enhance their returns and secure their financial future.